So as we can see on the title slide here, we're talking about mandatory climate disclosures, particularly the metrics and targets section. So governance, strategy, risk being the other pillars, but today exclusively almost talking about metrics and targets. By means of introduction, next slide. My name is Zach Greening. I'm the Director of NettZero Carbon Advisory. We're a business unit that sits within the broader NettZero organisation, and as the name suggests, we specialise in emissions reporting and sustainability compliance. And a big part of our work is helping organisations navigate things like emissions reporting and practical implementation of AASB S2 requirements. We work across sectors, including property, mining, infrastructure, construction and professional services. So we spend a lot of time translating climate reporting requirements into something practical, commercially relevant, and importantly, audit ready. So today I'll mainly be talking from that practical implementation perspective, particularly around metrics and targets and what organisations are actually struggling with on the ground based on our experience thus far. So with that in mind, we'll be discussing how you can complete the metrics and targets section, looking at these 6 subtopics. We'll go through what you actually need to report, what can be excluded under transition relief, what scope 1 and 2 emissions actually are and how we calculate them, and what the story is with targets and if we even need to submit them. We'll then take a look at some real-world examples of S2 reports that have been submitted by the Group 1 entities. We'll give a bit of a critique on them and take away some learnings that might help you in your own reporting ventures. Finally, we'll look at the downloadable template that Afonso and I will send out after the session wraps. It's a metrics and targets template. It's got 2 sections. One is a kind of guided work-through sheet with definitions and examples linking back to the topics we'll discuss today. And the second being a report-ready table that you can fill out and then dump it straight into your report, easy peasy. And as Afonso mentioned, if you've got questions, pop them into the chat and we'll get to them at the end, or Afonso might interrupt me as I present and we can address them on the spot there before we all forget about what I'm talking to and move on to the next topic.
Just one thing with the questions, like I said in the past, I've met a lot of people in carbon accounting and emissions, and there is very few that have the amount of knowledge that Zach has. So feel free to ask questions and kind of pick his brain when possible. He knows 20 times more than I do, so please do ask.
Very flattering. Okay, before we get into the practical guidance section, I think it could be useful to spend a couple minutes grounding everything in what the standard actually says. We've all read blog posts, or some of us might have read blog posts or attended webinars like this, but what does the actual standard say and what are the expectations it sets forth? So you can download the full text online from the AASB website. It's a dense read, but for the metrics and targets section, a handful of paragraphs really do most of the heavy lifting, and I've summarised them here. The original is a wall of text, but what we can see on the slide here is a nice, accurate representation. And first, a framing point that I think really matters. There's a common misconception that S2 is essentially a sustainability report with a legal wrapper around it, and I'd push back on that. This is a risk disclosure standard, and it's not asking whether your company is performing well on ESG metrics or how many trees you've planted or whether you have an ethical supply chain. It's asking, do you understand the climate-related risks to your business, and can you demonstrate that understanding to investors? That's a materially different question, and it changes how we should approach preparing that disclosure. So with that framing in mind, the key paragraphs are 27. The word that we should be focusing on in paragraph 27 is performance. It's not intentions or aspirations or commitments, it's performance. And this pillar is the accountability layer of S2. Everything else in the standard builds towards this. Can you demonstrate with actual numbers how your entity is performing and using those numbers to measure yourself against risks and targets? Paragraph 29, there's a lot of content in paragraph 29, but an important piece is absolute gross emissions, absolute meaning total tonnes of carbon dioxide equivalent, which is how we would measure and report emissions, and gross, meaning before any offsets or carbon credits have been purchased and applied. If you do purchase carbon credits, that's great, but they don't reduce your absolute gross emissions. You report the gross figure first, and then if you have a net target, you can deal with your offsets in that part of the report. Also in paragraph 29 is the methodology requirements. This is something a lot of first-year reporters might underweight. You don't just give the absolute gross emissions, you also need to tell readers how you measured it, the approach you use, the inputs and assumptions, and why you chose that approach over other alternatives. And this is really important. That methodology disclosure is a co-equal requirement with the emissions figure itself. It's not a footnote or a cross-reference to a different document. It sits alongside that number in the report and provides crucial context. Paragraph 33. If you have a target, you need to disclose it. There's a couple of specific elements that we'll look at in a later slide. And then paragraph 35 requires you to report actual performance against your target. So if you announce a target or if you have a target and you disclose it, it's not a one-time disclosure event. It creates an annual accountability obligation. You need to check in each year against that target you've committed to. The standard is more specific than a lot of people realise. For the majority of paragraph 29, the disclosure obligation isn't really the question. The question is, how do you proportionately and clearly disclose, and and that is going to be the topic of the rest of the presentation today.
I'm just going to launch before you jump in, Zach, another poll if people have actually completed a carbon inventory or an emissions inventory, so we can guide the context with the information as well. So let me just launch that. Perfect. Awesome. Can keep going now.
Yeah, I'll be interested to see the results of the poll as well. We'll talk a little bit about the different scopes of emissions, but it'll be interesting to know if there's already people having that scope 3 conversation internally, or if we're really dealing with organisations that haven't even considered preparing an emissions inventory before. Okay, so we had a look at what the standard actually says, and this is just a really quick summary of what you actually need to report in year 1, what's mandatory, and some pink rows here that you can you only need to report if you've committed to them. So the non-negotiables are your scope 1 and scope 2 emissions, scope 1 being emissions from the direct burning of fossil fuels or refrigerant leakage, and scope 2 being emissions from purchased electricity. And like we mentioned in the previous slide, you'll also need to disclose how you calculated these results and your data sources, both in terms of your side of things, like where did you get your electricity consumption from? Was it from bills? Was it from metering? But also, what was the methodology you applied? Where did you get your emission factors from? The value by which you would multiply your kilowatt hours of energy to get subsequent tons of carbon dioxide equivalent. You don't need to report any scope 3 emissions. So those would be your upstream or downstream emissions. It could include things like purchased goods and services, waste or business travel. You don't need to include those in your first reporting year, but I'll add it's a good idea to start thinking about it because it is significantly more complicated than scope 1 and scope 2 reporting. And it would be wise to make use of that relief period in your first year to get a plan together, to pull a team together and start locating the data and developing a methodology to report your scope 3 emissions. If you leave it until crunch time, it's not going to be very pleasant. In terms of targets, so we can see those pink rows there, you don't need to have a target, and we'll talk about this more later. But as we mentioned, if you have a target or if you have an internal carbon price or if you have a remuneration link to climate performance, you need to disclose these, but only if you already have that policy in place. If you don't have these policies in place, that's perfectly fine. Just say that you don't and maybe give a nod to the governance structure that would inform these if they were to be implemented, and then you move on. And as it's the first reporting period, there's no expectation for comparative information. We're just starting off, so we don't really have anything to compare to. And we can see those relief asterisks there are things that we can exclude under the transition relief provisions within S2.
We had about 40% people who have completed a carbon inventory, and then the other 60% is split between not having completed one or just in progress. So very, very timely.
Yeah, brilliant. Well, for the 40% that have, I apologize in advance for repeating stuff you might already know, but I'm catering to the majority here. In terms of transition relief, there are some provisions baked into S2. And here we can see exactly what you can exclude. You can defer your scope 3s, your comparative year figures, and any forward-looking statements. And these in your report, if you don't have them, you just say that you're invoking your right to transition relief. Otherwise, it could look like a deliberate or accidental omission, which we don't want. What you can't defer are those non-negotiables from the previous slide. being your ones and twos, your methodologies, and your emission factors, and these targets, carbon prices and remuneration linkages, but only if you have them, as well as assurance, limited assurance on Scope 1 and Scope 2 emissions inventories. So these are the absolute must-haves in that first go around. And when you're reporting your emissions, the very first decision you and your organisation need to make is how to define your organisational boundary. This is really important. It's not something you can come back to later because it will flow through every single number you disclose. So this is the first thing that needs to be resolved. And there's two approaches you can use to determine your organisational boundary. S2 will require you to disclose which approach you chose and why. The first being the operational control approach. Under this approach, you capture 100% of emissions from any operation where your entity has the authority to implement operating policies. So if you control how it runs, you own the emissions. And this is the approach we recommend for most Group 2 and 3 entities. It's much simpler to define, and it's considerably easier to explain and audit, and by far the most common organisational boundary approach. The second allowable approach is the equity share approach. Here you report emissions proportionate to your ownership stake in each operation. So if you own 40% of a joint venture, that G measures all of its emissions and you inherit 40% in accordance with your ownership stake. This approach better reflects economic exposure for entities with really complex JV structures. And for some businesses, it's the more appropriate choice, but it comes with a cost being really detailed footnoting and methodological notes. The boundary is much harder to explain to a general reader, and it creates a lot more surface area for audit scrutiny and can lead to a lot more questions. So two important points, regardless of which approach you choose. First, your boundary must be consistent with the reporting entity in your financial statements. So if your financial statements consolidate a subsidiary, that subsidiary's emissions need to be within your organisational emissions reporting scope. And a mismatch between that accounting boundary and your emissions in boundary is a really common audit finding for first-year reports that we've seen thus far. And second, once you've chosen that approach, be it operational or equity share, you need to disclose the rationale. So don't just name the method, but explain why it was the appropriate choice for your entity structure. And for most organisations on this webinar today, the answer will be operational control. The complexity of equity share is really only justified when your business genuinely can't be accurately represented through that operational control approach. So we've established that we need to determine an emissions reporting boundary, and we've established that we need to report our Scope 1 and Scope 2 emissions. But what do Scope 1 and Scope 2 emissions actually mean? How do we calculate them? What does this look like? Scope 1 emissions are direct emissions from sources you own or control, so they're under your operational control. And it could be the combustion of gas or diesel on-site generators. It could be vehicles burning fuel, or it could be refrigerant leakages. Refrigerant charges are really detrimental to the atmosphere and the ozone. So if they're leaking out from our HVAC plant equipment, we consider that a direct fugitive emission and we report it under Scope 1. For a lot of Group 2 and Group 3 entities, you'll probably have pretty small Scope 1 emissions, especially if you don't have fleet vehicles or like direct combustion type plant equipment. That's fine, but you still need to show your Scope 1 emissions category, even if you have a 0 or a nil figure. A nil figure without an explanation is compliant, but just leaving it blank and moving on and not acknowledging it, we don't want to do that. So expect to have some really low figures for your Scope 1s if you're like a service provider with an office but no fleet. Scope 2 emissions arise from purchased electricity. So this is someone over at a coal fire station or a gas fire station. They're the ones combusting the fossil fuels, but then you're importing that electricity through the grid and consuming it on premise. The GHG protocol, which is our global emissions reporting standard. So AASB is like the disclosure standard, but how we actually calculate the emissions is informed by the greenhouse gas protocol. And we've got two allowable methods for calculating our Scope 2 electricity emissions that we use in conjunction with the national greenhouse accounts factors that are provided by the Australian government each year. The first allowable method for calculating your Scope 2 grid electricity emissions is the location-based method. This is required under S2. It's a mandatory reporting requirement. And this is basically you take your kilowatt hours of electricity consumed over the reporting period. So you look at all of your bills or you take all of your meter readings and add them all up. And then you multiply them by the state or territory electricity grid factor, where that energy was consumed. So if you're only consuming electricity in New South Wales, you go on Google, you look up the National Greenhouse Accounts factors, and you multiply your kilowatt hours by that location-based factor. If you've got multiple locations, say one in Queensland and one in New South Wales, you want to total all of your Queensland and use the Queensland factor, and then all of your New South Wales, you multiply that up by the New South Wales factor, you add those two numbers together, and that's your location-based Scope 2 emissions. The second allowable method is called the market-based method. And right now this is voluntary, but we see a lot of organisations doing it anyway. Instead of using that single figure location-based factor, you can actually take into account any additional renewable energy that your organisation is purchasing. So it's a slightly more complicated calculation, but if you're already making procurement decisions around renewable energy, either through a green power purchasing agreement or through a renewable energy certificate or a large-scale generation certificate, if you want to see that reflected in your Scope 2 emissions results, then you should use the market-based method and just do a dual reporting disclosure where you say, these were our location-based emissions and these were our market-based emissions, and they'll be quite different. The bottom panel we can see at the bottom of the slide here is a part most people underestimate. And again, this comes back to first principles that we mentioned at the very beginning. For every figure you report, you must also disclose how you measured it, which emissions factor you used, where they came from, any consolidation approach, and any significant estimation or uncertainty that was included in that calculation. So the number and methodology are both required as per usual.
Have you seen, Zach, any common mistakes that pop up or that you end up correcting clients or other people in terms of how they are formatting the methodology of the emissions calculations?
Yep, so I'd say maybe a common stumbling block is whether or not we should be putting something into Scope 3. So Scope 3 sits alongside 1 and 2, but this isn't the same as I buy petrol, I put it in a car, I drive around and it generates emissions like Scope 1. Scope 3 would be like I have a subcontractor that drives around in a car and generates those emissions. And it's still petrol being combusted, creating greenhouse gases and going into the atmosphere. But if I'm not buying that petrol and using it like myself through my organisation, if it's a subby or someone else using it, that technically sits in our Scope 3 emissions categories. Likewise for grid electricity. If I'm in an office and I'm a tenant and there's a common shared facility or a shared area, and I'm not the one paying the electricity bill, but I still go out and sometimes I turn on the lights or I use the TV or something like that, and it's drawing electricity from the grid. That also sits in Scope 3 because it's not under my operational control. I have no say over who that energy provider is or really how that energy gets used. Therefore, that will sit in Scope 3 emissions categories, not in Scope 2. So Scope 1 and Scope 2, they really need to be under your direct operational control if you're using the operational control approach, or under the operational control of the JV or the other unit if you're using the equity share approach as well. So being really clear about what needs to sit in Scope 3 and then what we realistically have to put in Scope 1 and Scope 2.
Perfect. Thanks.
So we've discussed our emissions measurements. I suppose that's a metric. The other component that we have to disclose, again, if we have one, are targets. And no, S2 doesn't mean you have to set a target, but if you have one, you need to disclose it. If you don't have one, just say so explicitly. Again, don't omit this section. Just say we don't have a target and then mention the governance structure that could inform any potential future target settings and where that power to make a decision about target or no target sits within the organisation. AASB actually defines a target. They released some guidance yesterday based on some of the Group 1 entities reports that have been submitted. There was some uncertainty about, what exactly is a target. What they defined a target as was the quantitative and qualitative climate-related targets an entity has set to monitor progress towards achieving its strategic goal and any targets it is required to meet by law or regulation. My take on it is if you have publicly announced that you have a target, you've committed to a target. Otherwise, you could describe it as an ambition, perhaps. What they're talking about here in terms of meet by law or regulation are mostly safeguard mechanism reporting entities. So these are heavy emitters, usually in heavy industries or energy generation, that by law have to reduce their emissions each year as part of our national emissions reduction plan. However, if you've publicly released an emissions reduction target, a net zero target, a science-based target, or anything like that has now been circulated and been disseminated by your organisation, the expectation would be that you disclose that and report back against it. If you have a target and you're disclosing that target, we can see on the screen here that there's 7 elements required to complete that disclosure. We'll just focus on 2 of those elements that trip people up sometimes, the first being element 5. So we've got 2 types of targets that we can set, an absolute versus an intensity target. And we'll look at some graphs on the next couple of slides. But just briefly, an absolute target is a reduction in total emissions. For example, my absolute target is to reduce Scope 1 and Scope 2 emissions by 30% from a 2022 base year to a 2032 finalisation year. And that number needs to go down, that number of total absolute gross emissions needs to go down regardless of whether my business grows, I acquire new assets, I expand operations. Once I've committed to that absolute target, I'm expected to be reducing in line with that up until the finalisation year. The other type of target you can set is an intensity target. And this is a ratio of emissions relative to a business metric. So it could be reducing tonnes of carbon dioxide equivalent per square metre of office space by 25% between 2020 and 2030. This might be a target for a commercial property portfolio. Or it could be an energy company that wants to reduce their tonnes of carbon dioxide equivalent per kilolitre of feedstocks processed. So intensity targets are legitimate, but you really need to define clearly that denominator and apply it consistently year on year. The other element that can trip people up is that last one here, progress against the target in the current period, element 7. You can't just restate the target each time you report. Once you've committed to it, you need to measure your progress against it and disclose that. So if your base year was 4,000 tonnes and you're currently at 3,100 tonnes, great, we've made a 22.5% reduction. But if you're going over it, you need to disclose that as well. So it's really something to consider before you set a target. Is it achievable? What does it actually mean for the business? And are we going to be able to feasibly meet this in years going forward, rather than does it sound good right now?
Just noting that I've opened up a poll a few minutes ago if you ever set a target. So feel free to jump in there and answer. And thanks everyone for the one who's been providing answers. Thanks, Zach. Go ahead.
Yep. So here we're looking at a nice graph of an absolute reduction target. We can see these stacked bars are their Scope 1 and Scope 2 actuals, Scope 1 being the dark green on top and Scope 2, so their electricity, being the teal below. And that pink dashed line there is the required trajectory to hit their target. So every year their bars stacked on top need to come in below that line. And what this target is a 55% absolute reduction with their base year, so their initial measurement being 2022 and their achievement year being 2032. And this is a common type of target, sometimes called a science-based target or a Paris-aligned target. And this is the business saying, for us in our small part in the grand scheme of climate change, what do we have to do in terms of our emissions reductions to align with the Paris Agreement goal of limiting global warming to no more than 1.5 degrees above pre-industrial levels? We can see that trajectory continues out to 2032 because that's where the organisation is committed to land. And as we mentioned, regardless of whether the business grows, the business shrinks, they do different things, they hire more people, they make more money, they need to stay under that pink line because they've committed to an absolute reduction target. By
Zach,
comparison, yes?
Zach, if it's okay, just on the point of target setting, there's a question in the chat from Eliza, which is, are Scope 1 and 2 targets sufficient, or is it best practice to also include a Scope 3 target? What is your opinion on target setting in terms of targets that relate to Scope 1 or 2 reductions?
So there's lots of different ways that you can set targets. You could set a Scope 1 target, a separate Scope 2 target, and a separate Scope 3 target. You could set a Scope 1 through 3 target. It really depends on what that means for your business. Where are you chunky in terms of your emissions inventories? Where do you see potential to effectively reduce emissions over time? We'll get into some of the ASRS submissions later and look at a target set by a oil and gas company, which splits out their Scope 1s and 2s into separate targets. They do an intensity target for their scope 1s because they're generating energy, and then they do an absolute reduction target for scope 2s. Why do they do this? Well, scope 2s are much easier to reduce in a linear fashion because you just buy more renewable electricity. So setting a scope 2 target or a renewable energy target in terms of implementing it is relatively straightforward. But because they have this massive refinery plant and they're buying all of this gas and this coking coal, there's not really a good way for them to reduce their scope 1s along that same kind of linear fashion. So they end up buying offsets instead and trying to use offsets to reduce the intensity of their feedstocks and their energy productions and things like that. In terms of scope 3 is probably the hardest to keep reducing over time, especially if you have a growing business. So scope 3, I'd really be looking at an intensity target, which we'll take a look at on the next slide. But if you are in a stage of growth, intensity targets are a really good way to express that the business is becoming more efficient, even though absolute emissions are increasing. If I produce water bottles, and right now I'm producing per water bottle is 100 grams of carbon dioxide equivalent, but I grow my business, I grow my emissions efficiency, and I'm able to produce that same water bottle for only 50 grams of carbon dioxide equivalent, but I'm producing 10 times as many water bottles and my absolute emissions have gone up. Like, I'm demonstrating that I'm doing it more efficiently, and therefore if I'm taking a larger share of the market and I have a lower emissions value per unit of product, that's still kind of pushing the needle in the right direction. And intensity targets will, segue onto the next slide, but it could be per unit of production, it could be per unit of economic value, so revenue or floor space or energy production or full-time equivalent. So there's lots of different ways to express that intensity target for scope 3s. I hope that answers your question, but we can always come back to it at the end of the presentation. Okay, so intensity targets. This one looks similar to the last graph, but if we look at the y-axis, we're actually measuring tons of CO2e per $1 million of revenue. As revenue grows, your intensity can fall even if total emissions stay flat or rise slightly. And that's the fundamental difference between an absolute and an intensity target. Intensity targets are legitimate under S2, but they also require you to really clearly define that denominator and apply it consistently. So under this one, where we're looking at $1 million per revenue as the functional unit of comparison as the denominator, if you change how you calculate revenue, so you make acquisitions, disposals, accounting changes, your intensity metric could move around as well. And you need to explain that in your S2 report. If it starts looking a bit funny, you need to be able to reconcile that. In this example, the actuals are tracking ahead of that trajectory, falling faster than required. And this can happen when your emissions reductions and revenue growth compound together. So you're making more money, but you're also making efficiency gains as well. You're earning more, you're emitting less. So you can still meet those intensity targets while absolute emissions grow, so long as growth in revenue outstrips growth in absolute emissions. It looks really good on paper, but a sophisticated reader will still look at your absolute gross emissions at the front of the report as well. And that's why S2 requires you to disclose those gross emissions regardless of what type of target you set. So if you do set an emissions intensity target, it doesn't replace your gross emissions figure at the front of the report. You need to report both of them. There's two more metrics under paragraph 29. Both of these, again, you only need to disclose them if you have an existing policy in place. My assumption would be that for most organisations attending today, you don't have these policies in place, but it could be something that you're looking at in the future, particularly if you're thinking about offsetting your emissions or doing a renewable energy power purchasing agreement or something like that. So the first additional metric is an internal carbon price. What is it? It's basically a dollar per tonne value, a hypothetical value that you place on carbon dioxide equivalent emissions to make those carbon costs or potential carbon costs visible in your business decisions. So companies use this to stress test capital investments against future carbon costs. Could be a carbon tax. They compare the economics of lower emissions alternatives or set a hurdle price for offset purchases. If you use one, that's great. Disclose the price, what it covers and the methodology behind it. If you don't have one, that's great too. Just state that you don't have one. And again, reference back to the government process that could determine if you have one in the future or not, who makes that decision, and then you move on and you're done. Second being your remuneration linkages. So this could be if a climate metric or KPI is connected to executive pay through short-term or long-term incentives. If you have this policy in place, you just need to explain how that works and who that linkage is for. So a vague reference to ESG considerations for executive remuneration won't cut it. A good example would be a CFO with 15% of their short-term incentive tied to delivering on the S2 disclosures. Or it could be something else like an operations executive reducing operational emissions by 5%, and that's KPIs tied to their remuneration bonus. So named, quantified, unambiguous. And again, if you don't have one, you just say so. So we've covered quite a lot, but what does good actually look like? We'll take a peek at some examples from previously submitted reports in a moment. But in a nutshell, be proportionate and clear. If you have low emissions, explain why you have low emissions. Don't just leave it as a nil value and say nothing more. State your boundary rationale. We chose operational control because disclose your targets or explicitly state that you don't have any. Always source your methodology. And importantly, connect your metrics back to your risks and your strategy section. I know we're not covering risks and strategy in this particular session, but it's an important concept that your whole report has a thread of continuity through it. If you have a risk identified, maybe you want to have a metric to measure progress against that risk. Common pitfalls to avoid. Don't scatter your figures across 5 different documents that you need to assemble like a collage to make sense of what you're writing in the report. Likewise, don't drown every number in footnotes. You should be able to find a way to express it concisely within the report text itself. Outside of regulatory do's and don'ts, just from a practical perspective, don't use that relief provision as an excuse to do nothing on Scope 3 emissions. Year 2 will arrive really quickly, and if you're left scrambling to pull together your Scope 3 emissions inventory, particularly if you have a complex value chain, do yourself a favour and start thinking about that right now. Other things that might catch people out in their first report would be vague target language, like we aim to reduce emissions, but there's no base here, there's no scope, that's not a compliant target, so just say you don't have a target instead of doing that. And metrics with no narrative linking back to your strategy might read as box ticking. So again, having that thread of continuity through the different pillars of the report. So that sounds good in theory, but we'll take a look at some of the early Group 1 reports that have been published. But before we do that, Afonso, have there been any other questions in the chat?
Yeah, if you can just briefly answer a couple of questions, which was, can you combine your Scope 1 targets and can you achieve those through offsetting?
Yes, and yes. So I'm not sure what you mean by combine your Scope 1 targets. Like you should have one Scope 1 figure, but it could be split out against like gas and diesel and fugitive emissions. If that's what you're talking about, yep, you can combine all of those together into a single Scope 1 figure. And as we'll see in the next slide, or in the next couple of slides, some organisations are already using offset certificates to help meet those targets. But it's important that we come back to it won't reduce your absolute gross emissions, but it can help in terms of an intensity metric target. So it's important to delineate between those two. So it won't make your gross emissions go down. But if you have a net being gross minus offset type target, then yes, you can use offsets to help achieve that target.
Perfect. And lastly, in terms of third-party assurance, is it needed to get third-party assurance on transition plans prepared by the reporting company? I
believe it's limited assurance for year 1. Something that Afonso and I have been talking about with lots of different companies is start that conversation with your auditors really early on. Don't leave it up until the first draft has been prepared to start that conversation with your auditors around expectations and scope. Get them in the room early to have that discussion to make sure everyone's on the same page. We'll look at some examples in a moment, as I've said, but there's been, I wouldn't say the precedent has been truly settled in terms of auditor expectations at this stage. Different firms, different branches within the same firm are sometimes preparing to different, levels of scrutiny and standards. So engage them early in that discussion to make sure there's not a misalignment of expectations.
Perfect. Thanks, Zach.
Okay, so we said we'd look at some examples about 1,000 times, and now we're doing just that. This is Pepper Money. So Pepper Money are a non-bank lender, so they're sitting in the financial services sector. And we're not just looking at the content here, but also the structure of their metrics and targets section. Pepper Money open by stating the framework that they've used, the GHG protocol, no surprise there. They then state their boundary choice, which is operational control, and point back to where that decision rationale lives in the governance section of the same document. 2 sentences, nice and quick, love it. Their Scope 1 table, they break it down into 3 categories, each handled directly. For electricity generation, so burning coal to make energy, they basically say we have no emissions because we don't do that. We purchase all of our electricity from the grid. All right. For fugitive emissions, so those refrigerant leakages we were talking about earlier, they actually went and collected refrigerant registers from all of their different office locations. They talked to the building managers and they confirmed no refrigerant charge top-ups occurred in the reporting period. So the assumption is, and they list this out, if we're not topping up the refrigerant charge tanks, that means none's leaking out. Therefore, we have no fugitive emissions from refrigerant leakage. And that's genuine fieldwork, really transparently described. For transportation, so petrol in the car making emissions, they say we don't own any fleet vehicles, so we have no Scope 1 emissions for that source. All of our employee commuting and employee transport is all correctly categorised in Scope 3, exactly where it should be. So this is explained, categorised correctly, really good. So what makes this good isn't that they have a nil or low number. What makes it good is that a reader, an auditor, or an investor can follow exactly how they got to that nil result with every category considered and the nil figure explained, all of their data sources named as well. Here we can see their metrics in more detail. I apologise if the text is a little bit small, but I've tried to highlight some of the important parts here and I'll speak to them, so don't strain your eyes too much. Their Scope 1 result, 0, we've already addressed that. They don't skip it though because it's a nil number, they still include it. Their Scope 2 section is a really good teaching example as well. They've got a total of 678.18 tonnes of CO2 equivalent, so relatively low, but one number clearly totaled. It all comes from indirect electricity usage. They're buying it from the grid. But take a look at that methodology, approach, input, assumption, justification, all broken out separately. And they also had a kind of tricky problem to account for. Their Manila office in the Philippines doesn't publish government-endorsed emission factors like we have in Australia. So well, how do we calculate our Manila office Scope 2 grid electricity emissions? And they tell us what they did. They took emission factors from 3 similar countries, Vietnam, Malaysia, and Thailand, and they averaged them out. They made a methodological note, and then they applied that to their electricity consumption from Manila. And this is a really nice piece of carbon accounting. And they documented it super clearly. Instead of leaving a gap or an omission, they approached the problem, they made a defensible methodological deviation, and then recorded it all really clearly, which I'm very impressed by that. They also disclosed this little pro rata day count assumption that they had. They had a couple of utility invoices that didn't match up perfectly with the reporting period. Some of them spanned over from the December 24 through to January 2025. So they just told us how they accounted for that gap in the cycle and how they adjusted that pro rata calculation accordingly. And then on the right side of the screen there, we can see their targets, 3 target disclosures, all handled separately. First, they say no internal carbon price, 1 sentence. Remuneration linkages, they say the CFO is 15% of STVR tied to S2 report delivery, so named and quantified. And targets, they say none set for this period. I would like to see them link back to their governance rationale in this section. You can see that last piece, section 5, governance. We can see that that's where the authority to set targets and do remuneration linkages and all of that sort of stuff sits. So they do address it further up in the report, but it would be really good to see them just call back to that in this section so we don't have to scroll back up and read it if we're just looking at metrics and targets. But otherwise, it's really tight. And I quite like how they've approached this for a business that realistically has really low Scope 1 and Scope 2 emissions.
Zach, just a question before you move on to the next slide that came through was, assuming that the disclosing company hasn't set a target, will this impact negatively kind of investor responses? For example, them having an expectation that the entity should set a target. So it's basically it's not mandated that you need to disclose a target, but the expectations from maybe peers or users of the report.
Yep. So without going on too much of a tangent, ask your investors, is it important to them? We do something called a double materiality assessment, which is where you look at a bunch of different ESG and sustainability topics, and you create surveys for your different stakeholder groups, and then you send them out and you pull back those responses, and then you calculate the likelihood, scale, and magnitude of different kind of climate change or ESG possibilities, and you map them against your risks matrix. So if you're getting feedback from your investors that say we don't care, then don't set a target if it's going to mean that you're kind of cornered into something that's difficult to achieve. If some of your big customers are, say, state or federal government, and you know that they have an existing net zero or sustainability procurement policy, then it would, from my perspective, it would make sense to align yourself with that and be part of that story and be easy to do business with. But we know that some investors don't care, and some are much more motivated. So really, that's a discussion for you to have internally if you think it's something your investors or your customers are going to be sensitive to, and what the trade-off would be for how difficult is it to set and achieve that target. Some of the science-based targets, like their Scope 1 and Scope 2 targets, are pretty achievable. Some of them end up being around 4.2% net reduction year on year. And if most of your emissions are coming from Scope 2 grid electricity, and you can, pay an extra 5 cents per kilowatt hour for a green power purchasing agreement or renewable energy certificates, you can make that emissions reduction, you can take some really big chunks out. If 80% of your emissions are Scope 2 and you need to reduce 4.4% each year, and then you just decide we're just going to buy all renewable energy, you're sweet for like 20 years. So sometimes the targets can be really achievable. But if you've got really heavy Scope 1 targets, or Scope 1 emissions, it can be much more difficult to try and phase those out. It's harder to transition your fleet to EVs than it is to just opt into a green power purchasing agreement. I did go on a bit of a tangent there, so I apologize. But again, I hope that answered your question.
Thanks, Zach.
Okay, so these guys, we will talk about their targets, but this is the emissions inventory for Viva Energy. They refine, import, or distribute about a quarter of Australia's fuel requirements. So unsurprisingly, we see some pretty big numbers here. These are all tons of carbon dioxide equivalent. Interestingly, Viva has elected to include their Scope 3 emissions voluntarily, which they didn't have to do. That's that kind of like 41.9 million tonnes of upstream or downstream emissions, from people using their product, aka combusting their fossil fuels, and they've elected to include that as well. I don't mind this chart. I would have liked to have seen it as a table as well, but they did a pretty good job of expressing and summing up their different emission sources. So pretty good. They give us a really clear methodological explanation of how their Scope 1s and 2s were calculated, but we'll just look at their Scope 1s here. They say their Geelong refinery is the main contributor, which makes sense, and it's a combination of direct measurement and plant equipment sensors and the quantities of combusted coke. They're getting their quantities from invoices, so they're giving us a few different data sources that they've used to identify how much feedstock and fuel they're consuming to produce their electricity on site. They also note that the emissions calculation methods were the NGES Method 1 and Method 2. So NGES is another compliance reporting standard that they have to complete each year because they're a large energy generator. So, they've included all of this detail. It's worth noting they would have had to complete this report anyway under NGES, but because it's relevant to ASRS, it's great to see they've included that same level of detail in this report, which can't be said for all reporting entities in year one. We'll skip over their Scope 2 and Scope 3 emissions in the interest of timeliness, but we might fast forward to their target section. Because they didn't just set targets, they actually changed their old ones and explained why. They'd originally set a 2021 target, but by 2025, they'd introduced a new convenience and mobility business division, but they also had to grapple with the safeguard mechanism. So that's new-ish legislation that affects large emitters, energy generators, heavy industries, and these sorts of guys, and it locks them into a set emissions reduction based on 2018 through 2022 average baseline. So rather than quietly dropping the old targets and kind of sweeping them under the rug, they just disclosed that they are no longer fit for purpose. They've revised them and elaborated on the strategic rationale behind their new targets. Their revised framework is pretty simple. It sets two targets, so they're splitting out their 1s and 2s. Their Scope 1 target is aligned to their safeguard mechanism obligations for their refinery. It's an intensity target. They want feedstock emissions intensity to reduce to 0.138 tonnes per kilolitre of feedstocks processed by 2030. So that's a 14% reduction against their baseline. So that's good. They've given us the base year, the achievement year, the intensity metric, and the denominator. So meeting all of those intensity disclosure criteria. Their scope 2, then they're using ACCUs. So the other thing is they're pretty upfront in their report, and you'll have to take my word that there's like 5 or 6 more pages on methodological notes. I wouldn't put them in here, but they basically say we have no low carbon alternatives for coking coal and natural gas. Like there's no short-term viable pathway to a low carbon alternative. So we're going to spend each year $3.5 million on Australian carbon credits to meet that safeguard mechanism compliance obligation. So they don't try and obfuscate, they don't try and hide it. They're just upfront. They're like, this is what it is. This is how we're going to do it. They keep it all above board. Their scope 2 target is a voluntary procurement target. So 40% renewable electricity by 2030. And they tell us we're going to do that through a 10-year power purchasing agreement for renewable electricity and surrender renewable electricity certificates as well if we come in over that agreed PPA volume. So each target has a scope, a metric, and a time frame, and quite a lot of detail as to how they're going to get there. Final thoughts on their targets. They distinguish between a target and an ambition, which sounds kind of lawyerish, but I think it's really important to also protect yourselves. Using this 2050 ambition here, they're saying they want net zero scope 1 and scope 2 emissions across all operations by 2050. One, it's an ambition, so it's directional. It's not a hard committed to target. And we can also see net zero scope 1 and scope 2. The assumption is that they'll continue to use offset certificates to take their absolute gross emissions minus their offsets and get their net emissions, that net zero scope 1 and scope 2 target. So they're pretty clear about it, and I like that it's upfront. We'll now take a quick look, and I can see we're running out of time, but we'll look at a player that could do better. AMP is a lot like Pepper Money. They're a financial service provider. They're actually a fund manager with about 60 billion under management, but relatively small physical office footprint, low scope 1 emissions, and it should be a really straightforward disclosure, but it ends up being just kind of thin and a little disappointing. So text on the screen is probably too small. That's fine. It's more to get a sense of scale because this is their whole metrics and targets section. It fits on one page, and about a third of that is their greenhouse gas performance summary table and footnotes. So pretty skinny on content here. The emissions table has no methodological narrative sitting next to it. It actually has notes directing readers to a separate greenhouse gas reporting criteria that sits on their website. So you're reading along, you go, okay, additional details, section 1. Oh, wait a minute, that's in a completely different document. So to understand how they get their results, you've got to go Google search it. Which I did. On their target section, they just completely omit it. Targets appears in the section heading and the section subheading, but there's no 4.4 targets. They don't have any and they don't mention it whatsoever. So Pepper Money, pretty much the same scenario. They just said, we don't have this target, we don't have that target. Here's the section in the governance part of the report that tells who makes that decision and what that process looks like. So all they had to do was just do what Pepper Money did and just say, we don't have a target. But instead, no mention of it whatsoever. AMP also characterises their climate exposure as immaterial, but you look at their portfolio of funds and you can see they've got BHP, Woodside and Alcoa in their top 10 holdings for one of their Aussie diversified funds. In their international funds, they've got 1/3 sitting across energy, materials and industrial sectors, which are kind of at the center of most climate transition risk frameworks. And it's not a criticism of the holdings, but it's context that investors probably need to assess the climate risk, and it's context their report doesn't really provide. So even if you don't quantify that risk, calling it immaterial seems dubious. And I actually found it really annoying because they already have all of this data. It's just scattered across disparate different documents. You can go find that independently, up on their website, not in a convenient place, GHG accounting methodology, but that document references another document, which is their carbon fund footprint document. And then if you look at them all together, you can see that specialist shares fund, which has immaterial climate risks, has got 220,000 tonnes of CO2e per year, 12% of which is directly tied to mining. So it seems like something worth mentioning in your disclosures, especially when you already have all of the required information. Now, we know they didn't have to disclose scope 3 emissions in their first reporting year, but we'll take a look at the next slide and we might see why it could have been a good idea to at least acknowledge that significance somewhere in the report. The no direct exposure framing in their metrics section actively contradicts their risk descriptions in the strategy section of the same report. They acknowledge that stranded asset risk and portfolio return impacts from investee companies failing to decarbonise are risks. But the metrics section then characterises that exposure as immaterial, and these positions are never really reconciled. Fine. On the physical transition stuff, they assessed their portfolio, they disclosed the methodology and concluded that physical risk wasn't material. But for the transition risk row, they only cover their own compliance costs. So there's no assessment of transition risk flowing through the managed funds, which is kind of the whole basis of their business, and no analysis of what that transition scenario and decarbonisation scenario means for that 60 billion of funds under management. So they're kind of saying the summation of their risks might be higher energy prices for a couple of offices and some increased compliance costs for doing this report each year, but there's not risks associated with that 60 billion in funds under management, a lot of which is tied to highly exposed sectors. So, all right, a little bit of a tirade, but I think we can learn something important from it, which is, one, read your strategy, read your report as a skeptic before it goes out. If your strategy section identifies a risk, maybe put a metric to it. Pardon me. If you don't tie it back to a metric, explain why. Viva did a good job where they didn't have a viable short-term reduction pathway, but they said so directly in that same section, and then explained how they were going to achieve it a roundabout way using cues. Another key takeaway is that silence on targets can read as avoidance. So one paragraph explaining the board's position, the governance process, that costs nothing in your report. Pepper Money set the standard here, but no targets, but they explained it, they disclosed it, versus AMP that just left it blank, where they could have just used literally 3 sentences and been sweet. Here's a little list. We're almost done with the presentation component. These are just some action items, things to think about now, in the next couple of months, and then at disclosure time. And by sequencing them out like this, you can make life easier for everyone. So, after this call today, start thinking about your organisational reporting boundary. What do you need to include in that report? How are you going to get the data for your fuel use and your electricity? Most of you will apply the GHG protocol, so maybe download a copy of the methodology. And the underrated one, get started thinking about Scope 3 mapping. You don't have to bite the whole thing off and chew it right now, but get thinking about it because this takes time to develop, and you want to get a head start before you hit that limited assurance reporting cycle. Over the next couple of months, actually collect all of your Scope 1 and Scope 2 data. So get copies of all of your utility bills for your different office locations, your different facilities if you have them, all of your fleet fuel reports and purchase records for gas, diesel, refrigerant top-ups and things like that, and create a well-labelled folder somewhere within your organisational file structure and keep all of your bills there clearly labelled and have them on hand for when you need to start that reporting process. Also, consider targets. Like, do you want a target? Do you think it's important to your investors or your customers? If so, what does meeting that target mean for your business? You're going to have to spend money on renewable energy or on EVs, or you're going to have to transition away from gas boilers to electricity-based plant equipment. So there are all implications for targets. So you need to have a well-considered internal dialogue about if you want one and what you have to do to achieve it. And then, like we mentioned, talk to your auditors early. Get them in the room and make sure there's not an expectation gap that kind of spooks you when you get that first draft ready and send it for an initial review. And if you do all of this, that last box should be really easy. Just remember what we spoke about in terms of being clear on your boundaries and methodologies. Do your location-based Scope 2s, but also try and do a market-based. And if you use estimations or transitional relief, just be clear about that. And ensuring that your metrics have that thread of continuity back to your strategy and risk sections. We'll wrap up, and Afonso will send out an email after this call, but we did prepare this metrics and targets disclosure template. So on this page, you basically have a reference to each of the paragraphs in the standard, but also some guidance notes on, what type of stuff do you need to include in here? Might this be relevant to your organisation or not? And this allows you to put down your disclosure data, but also all of your measurement approaches and sources. So we're making sure we're giving the number, but also the justification. Once you complete that table, you can transfer it over into this report-ready version, which is essentially has been formatted so you can dump it straight out into your S2 report and make sure that you're disclosing correctly into a high standard against all of those paragraph 27 through 30 requirements. that's it from me. I hope you found it informative. I hope you can make good use of that reporting template. Do we have any more questions from the chat, Afonso, or does anyone have a question they'd like to send through now?
We've answered all the Q&As that were popping up via the chat, and I've responded to some privately as well, that were just kind of sent directly. My closing thoughts is, it can be a lot of information what just Zach described, but with enough planning and timing and gathering of resources, you can get the ball rolling and understand that, if you need help, there's people to help you, but having the methodology at hand, the greenhouse gas protocol, looking at other reports can help you set the context of what a good look like. And if you want someone to critique that and help you understand if you're looking at it's good, you can feel free to shoot us a message to Zach or myself, and we're more than happy to help. Like I said, it is invaluable to have Zach on the call here as one of the partners of NetNada. The NettZero team is phenomenal, and we can recommend them more highly. But we understand it's a lot of information, it's a lot of context, it's a lot of budgeting and planning. So if you ever feel you need help, just let us know. This is the third session. There's 2 more sessions after this one before we wrap up. But that's it. Zach, any closing thoughts that you want to send people away with?
I hope I didn't overwhelm you. I think that that template that we've got does a good job at kind of breaking it down into those bite-sized pieces. And, Rome wasn't built in a day, and this is a new report type for most entities going through it for the first time. So taking those baby steps, thinking about things along a practical timeline, and making sure you're meeting those minimum disclosure requirements. And, do you really need a target, and this sort of stuff can make it a lot easier to get through that first evolution. And as Afonso said, happy to have a chat or a brainstorm or answer any questions you might have if you wake up at 3 o'clock in the morning thinking about climate disclosures. God help you if that's the case.
Thanks, Zach. Appreciate it. And everyone reply to my email that I sent across if you want access to Zach's template. Awesome. Thanks, everyone. Cool. Have a fantastic Tuesday.
Thanks for having me, Afonso. Have a good one, guys.